If you're freelancing or earning 1099 income, and you've ever felt like your tax bill is way higher than it should be, this is probably why there's something called self-employment tax, and it catches almost everyone off guard the first time. You'll usually hear one number, 15.3%, but that number by itself doesn't really explain what's going on. So let me walk you through this in a way that actually makes sense. Self-employment tax is completely separate from your income tax. It covers Social Security and Medicare. If you've had a normal job before, you were already paying this. You just didn't notice it because you paid half and your employer paid the other half. When you're self-employed, you're both, so you pay the full amount yourself. Let's look at what that actually means. If you're an employee making $60,000, you pay about 7.65% and your employer pays the other 7.65%. But if you're a freelancer making the same amount, you're responsible for the full 15.3%. So even though the income is the same, your out-of-pocket tax is basically double. That's the first big surprise for most people. Here's where that 15.3% comes from. 12.4% goes to Social Security, and 2.9% goes to Medicare. Together, that's 15.3%. And this is on top of your income tax, not instead of it. There is one important limit to know. For 2026, the Social Security portion only applies to your first $184,500 of income. Anything above that is only subject to the Medicare portion. And if your income is high enough, there's also an additional 0.9% Medicare tax. Now here's something most people don't know. You don't actually pay 15.3% on all of your income. The IRS only applies it to 92.35% of your net earnings. It sounds like a random number, but it's there to account for the employer portion of taxes. Let's walk through a real example. Say you make $60,000 after expenses. First, you multiply that by 92.35%. That brings you to about $55,410. Then you apply the 15.3% tax rate. That comes out to about $8,478 in self-employment tax. And again, that's before income tax. Even at $50,000, you're still looking at around $7,000 in self-employment tax. That's why this adds up so fast, if you're not planning for it. Now here's one important benefit. You can deduct 50% of your self-employment tax when calculating your income tax. So in that $60,000 example, you paid about $8,400 in self-employment tax. You can deduct about $4,200 from your income. This doesn't reduce the self-employment tax itself, but it does lower your overall taxable income. So now let's put everything together. On that same $60,000, you might pay about $8,400 in self-employment tax and another $4,000 to $5,000 in income tax. So your total federal tax bill ends up around $13,000. That's over 20% of your income, and that's before state taxes. Most people don't realize they're dealing with two separate taxes. They only think about income tax brackets. But self-employment tax is layered on top. That's why people feel blindsided at tax time. And it's not just once a year either. You're expected to pay taxes quarterly: April, June, September, and January. If you miss those deadlines, you can get hit with penalties. The easiest way to stay ahead of this is to treat taxes as something you manage year-round. Set aside around 25 to 30% of your income and adjust as your income changes. This is actually why I built SnapTax. It tracks your income, updates your tax estimate in real time, and shows you exactly what to save each month. If you want to try it out, you can go to snaptaxapp.com and start a free trial. And if this helped, I'll be posting more videos that break this down in a simple way. Try SnapTax today. Know what to save and pay with confidence.